Hey everybody, what you've been waiting for all week long on the edge of your seat, just waiting for Sunday night or Monday morning. Hey everybody, it's our August 17th, Wall Street winners. Let's get going here. Whoa, this is so fantastic. All right, so last week we talked about the acceleration in the purple predictor. That's that purple line there, and it just took off, which was quite bullish. But notice that the market has ground to new highs, but the purple predictor actually failed to make new highs. So we have a little mini divergence there, which normally we would expect this week to be a weak week, if I can put it that way. Over here, also, the buying pressure faded. That's the little green line. The little red line, notice selling pressure didn't increase, but buying pressure decreased. The black line shows that this is a bull market. It confirms. That's called the ADX, and it is a strength of trend indicator. So there we go. The NASDAQ failed to make new highs. So this is part of the rotation that we've been talking about, how the market is getting out of the big FAANG stocks and into, well, more industrial, materials, utilities, consumer staples. They're moving out of the high risk and frankly overvalued stocks and into more conservative places. Now, it's going to be very weird. I'm going to talk about this in a minute, but that's what's happening on the meta level. Right now, we're still in the seasonally neutral period for the stock market, but you can see utilities, which this is a seasonally bullish time for them. They almost broke the high that we made in early June. And if we break the high in early June, I'm going to start getting long the UTS, which is the short way of saying the utility sector. We're not there yet, but we got awfully close here. Seasonally, the thing that we want to look at is the green line. That's the seasonality when a sitting president is running, which is certainly the case right now. And you can see we normally would expect a dip here in the latter part of August, then a rally up into the middle of September. Now, of course, really, starting really in September, the market's going to be dominated by obviously economic news and COVID, but also the expected winner of the election will start to come into play in September and really hit in October. It's going to become a dominant factor in the market. So we've been going along without really paying attention to politics, but starting in September, we really are going to have to start to focus on it. And so the market's going to be very driven by the polls. The market's going to want Donald Trump to be elected. It's not going to want Joe Biden to be elected, mainly for one simple reason, or two simple reasons. Biden is saying he's going to raise taxes, and the market does not like that. And in particular, he wants to raise capital gains taxes. And of course, capital gains taxes are like the worst thing for the stock market. So it's going to want a Donald Trump victory. Okay, couple of interesting things here. So we've been talking about how the Fed has been controlling the yield curve here now for months. We were one of the first people to reveal this control by the Fed even before they announced it. In the middle of June, we saw a spike up, and the Fed came in and slapped it right back down. We're seeing, and then lately, the last month, we've been drifting lower. In other words, the Fed had been forcing a flattening of the yield curve, which, as I explained to you, was not bullish at all. But this week, in the last week, we've seen a big pop up again. So this week, the one that we're just coming into, is going to be very critical, because the question simply is the Fed going to slap it back down the way they did in June? I suspect that they will. I don't think that they want long-term interest rates to be going up. So we will see. I, on the other hand, would prefer to see them go back up to where they were in March, because a positive yield curve is positive for the market and positive for the economy. Another thing, So last week we talked about it. It accelerated. People, the asset allocators, which is the big money in the market. We're talking pension funds, mutual funds, people like that. They're shifting out of the bond market and into the stock market. And so that's what's supporting the stock market right now. Now I need you to think about that. Bond people are buying stocks. So the stock market didn't rally much in the last week, and it was supported by massive movements of money out of the bonds into the stocks. Well, why didn't the stocks move stronger if there was so much money coming out of the bond market? Might be a sign of weakness. Riskicator, they want more risk. It started to accelerate it last week, and we got up a little bit higher this week, and we've stalled out. But usually a sign of more risk is a sign that the market is bullish. And certainly the market is grinding higher. The broad market is. Not the NASDAQ, but the broad market is grinding higher. So now let's... So the NASDAQ tends to be a riskier index than the S&P. And yet we saw a higher movement to risk. There's a lot of very interesting things happening under the surface of this market, which of course is why you're here, because you want to know what's really happening, not what the blah blah on TV is. Now this is quite interesting. So the NASDAQ, as you know, has been in a very strong bull market. The S&P has been grinding higher. It looks to me like global shares are starting to do a little bit better. And as I said, I'm going to start to focus more on these global shares going forward. Bonds, well, they bailed out of bonds. They hammered the bond market. As you can see, and as you know, we got out of bonds. So thank goodness we missed this big downdraft. Bond key factors. Let me stop. We haven't talked about this for a while because the Fed's been manipulating things. Okay. So down at the bottom, the green line is the bond market yields. Those are yields. So you can see we bounced from where it says 110, that would be 1.1%. You just put a decimal place in there. Right above that is a blue line, which are 10-year treasuries in Germany. Now, if you look at this chart, generally speaking, 10-year treasuries in Germany are lower yielding than 10-year treasuries in the U.S., but that stopped in March. And so when global investors look around the world, they say, well, where should I put my money? Should I buy German treasury notes or should I buy U.S.? And they've been buying U.S., which is why the yields are lower. But it put pressure on the U.S. rates to be higher because the biggest competitor was offering more money. So the Fed came in and bought the U.S. treasuries, not the global market. So now we see a bounce up in German yields. That's forcing a bounce up in U.S. yields. Okay. Now there's two other lines there. One is the golden line. That's the price of gold. And underneath that, in the middle of the chart, is a chart, a black and red lines. That's the CRB, or commodity prices. Now, when both gold and commodity prices are going up, that combination, that is a 6-month leading indicator of bond yields. So they both, we've seen gold go up for a long time, but the commodity index started to move up. It bottomed in April and has been moving up now for 4 or 5 months. So what this says is, late this year, you're going to start seeing an increase in yields in the Treasury notes. Now, this is assuming that the Fed allows it. In other words, the Fed doesn't come in and buy $1 trillion worth of bonds because, of course, $1 trillion will overwhelm the free market. But if there's a free market in bonds, you'll see higher yields. And that would be great because that would give us a more positive yield curve. Okay, U.S. dollar. Now, U.S. dollar this index is dominated by the euro. The dollar index is weighted towards where's the most volume. And the most volume is euro versus dollar. Second most would be versus the yen. So as you can see, we had a big drive down in May, down into lows in June. We saw a bit of a rally, a bit of a consolidation in the end part of June, and then another big leg down here in July, and now we've got a sideways consolidation. the rules of classical chart analysis are it's going to break down again. Now, that's important for a lot of reasons. Number one, a breakdown in the US dollar would mean that there'd be upward pressure on gold again. Okay, one of the reasons why gold collapsed is because the dollar stopped going down. In addition, a cheap dollar affects the S&P a lot. 50% of earnings of the S&P 500 come from outside the United States. It's really a global index. There's just no question about it. So it's going to have a big impact on earnings as well. Okay, so speaking of gold, so after that big drop, we got out of all of our gold positions, and I don't have any gold positions right now. I still think that the fundamentals are very bullish. But technically, the power of that down move was so strong that I just said, okay, let's just stand aside. Because probably I think there's a good chance we're going to just start heading down again. Maybe back to the support around 1,800 an ounce. Long term, still very bullish on gold. The factors are all in place to give us another leg up and get us up. I predicted 2,000 hundreds of dollars ago. You heard it here on the freebie version of Wall Street Winners. We should head to 3,000. Now, that's going to take a couple, 3 years, but we'll get there. All right. But right now, don't want to be long. Our indicators. The top one, let's call it bullish or sideways or neutral. The middle one, I think, is clearly bullish. The bottom one is clearly bearish. So we got kind of a bullish, a bearish, and a neutral bullish. Net, our short-term indicators here are not suggesting that we should be in the gold market. Crude oil, grinding sideways. I might be finally in tune with this market and looking to go sideways. And finally, Bitcoin. Okay, Purple Predictor took off this last week. The price has not taken off yet. I think we're going to break to new highs, and I'm going to want to go long Bitcoin now when it breaks to the new highs. So we've got two highs. We have an ascending triangle formation. Everything is lining up for a new leg higher in Bitcoin. I'll buy the break of the highs that we made in the last month, okay? With a stop loss, probably a good place to put it would be under the lows we made last week. All right, freebies, that's everything for you. Okay, freebies, thank you very much. Of course, you should be a fully paid up member so you get specific, actionable advice. That would be a much better thing to have than simply getting the general overview. All right, talk to you later. Fully paid up members, hang on just a second.